Todd, as usual, you've been a very busy guy. You recently posted an Elliott Wave Wednesday interview that you did live with a friend of ours, Peter Brandt. I understand that he is a trader's trader. Please tell us about that.
Yeah, that's for sure, Dan. It was funny. We became acquainted about 5 years ago, and Peter's as you just mentioned, he's a trader's trader, and he's actually I know friends and good friends with the company boss, Bob Prechter, and he's not quite an Elliott Wave guy, but he's one of these guys who kind of puts out the reality of trading for a living. I myself traded for a living. It's not glorious. It's not glamorous. It's quite tumultuous because, a lot of times when people come into trading, they say, I want to make this much money every month. And that's just not the way it is at all. Generally, early on in my trading career, in my mid-20s, I learned about the 80-20 rule. You're going to make 80% of your money during 20% of the markets. And that means the other 80% of the time, you have to just protect your capital, not lose in down markets. And that kind of volatility of a trader's P&L and their account is really hard to follow. And it was great. I don't know if you caught this part, Dana, but you said, I'm in a drawdown now. I've had 10 losing trades in a row. And this guy has an audited track return of 40% return over 4 decades or some ridiculous thing. It's, he's a great trader. So for him to say I'm in a drawdown just goes to show that trading is like a boxing match. You get in there, you take some shots, you always protect yourself. You're always protecting risk, guarding, but it's not glorious at the end of your trading quarter and year. So he puts it out there in social media. So I invited him to come in, and he's a guy who tells it like it is. And you got to respect that in this industry that has, unfortunately, a lot of smoke and mirrors.
Absolutely. I noticed that he was very transparent about that, and you are as well. I think that's something that people respect, and they know they can trust you for that.
Otherwise, I wouldn't have my relationship with Elliott Wave International.
Todd, in March, you were once again a keynote speaker at the Money Show in New York City. What did you talk about there?
Yeah, just what was it? In fact, a couple of the higher ups at Elliott Wave helped me craft my my title and my structure to talk about being fully transparent. It was trading yoga. I think in this kind of market, we're in a bit of a trending environment on the shorter terms, but longer term, I think we're in this kind of consolidation pattern. And specifically, if you're an options trader, you need to be flexible in your approach. When there are trending environments, both up and down, you want to structure your option trade such that you're buying options, looking for premium expansion. So paying for premium is what option traders call it. But in times where markets are going sideways, like we just came through quite a sideways period in the S&P, you got to be flexible and go ahead and look for strategies that would take advantage of the time decay of options, which is theta positive, scale back your deltas, which is your directional exposure, and go more towards theta. So, being flexible, I'm a big proponent of intermarket analysis as well beyond my Elliott Wave analysis. So I like to know what the wave count is in, let's say, the bond market or gold or crude or the interest rates, and kind of overlay that on a wave count in a correlated market. So I try to take a holistic approach and just say that I don't think, if you're you can be kind of a one trick, one trading setup trader if you like. But if you're managing a portfolio like I do for my members, you have to be able to shift gears depending on what market conditions are in front of you, because markets are constantly in flux, which is really the only constant is change in the market. So my point was just adapt to that.
You mentioned a consolidation pattern. Tell me more about that. What is that?
Yeah, it's just, that's why I love Elliott. Great question, Dana. There's only 3 Elliott Wave corrections in the world. There's flats, triangles, and zigzags, and combinations thereof. And if we're not in a trending environment, we fall into a corrective environment. And for option traders, that's great. It's a great opportunity to have an option strategy that takes advantage of a sideways movement. Like you can have an iron condor, which is a combination of a call credit spread and a put credit spread, or a butterfly, which is it's kind of the same thing, just a smush together. And the idea, as long as the correction is intact, you can take advantage of the decaying nature of options, make money while the market's going nowhere. And I would say the market, I don't know if there's any statistics out there, would probably range trade 70, 80% of the time and then trend the balance 20, 30% of the time. And again, I don't have any statistics to show that. So I think you want to have 2 strategies, as I mentioned, directional trading, or if you're just being, an underlying stock trader or futures trader or crypto trader, you want to be in. And if you're not trading options and we're going sideways, you kind of want to be out. So I like to take advantage of both trending and corrective environments, and options are wonderful for that.
Going back to the money show, when you speak to events like that, you are such an expert, but do you find that you are actually still able to learn something about trading?
I'm always I'm always looking to learn something, and I put this challenge out there like almost all the time. I'm not a big indicator guy, and I know some of the guys in-house at Elliott Wave International like to use indicators, and I'm talking about your traditional stochastics and MACD and stuff. I have not been able to find an indicator that adds any value on top of what the wave principle gives me. I think it's just such a confirming indicator, momentum divergence on RSI or whatever. If you identify an ending fifth wave pattern or C wave pattern, there's going to be attendant momentum divergence. So I'm willing to learn. But in terms of indicators, I haven't seen anything. And I've asked people, show me what tells me what the Elliott Wave principle doesn't already know. But in terms of risk management and the way to deploy capital, yes, I think you're always learning. But I'm kind of at the point, I've been doing this only for 20 years. I'm still young in my career, where I'm pretty happy with the methodology that I have. But in terms of being a better trader, managing capital, yes, you never stop learning at that.
And I understand that you recently put on a Lulu trade that had a lot of moving parts. It was an earnings option trade that was guided by the Elliott Wave count. Tell us about that.
Lulu is a holding in my portfolio. It was a really nice pattern. If we can refer over to the screen here, just kind of looking at the decline that we've seen in Lulu. I had this as a big corrective pattern in wave 4. We've moved up in a nice motive impulsive fashion here. And as I mentioned, I don't often look at indicators, but I do like to look at volatility. ATR is down here. Average true range was beginning to expand, which means high to low on each bar starting to move up, volatility starting to move up. I had this at the end of a kind of an ABC correction. It was a bit of an ending diagonal inside of C here if we go down to a smaller degree. And then it was earnings time. So I had this as a possible third wave. I find that earnings can be a gamble, but if you're in a good Elliott Wave position, you might have an idea that we could break higher in a third wave here. So I put the trade on. It was a defined risk butterfly, which basically option specifics and complicated math aside, basically you want the market to go up towards 162. That was the body of the butterfly. We went up to 172. Lulu really crushed earnings. We've pulled back here a little bit, and the trade worked out very well. I think it was 1 part risk to about 5 parts reward, done with real money, real capital. I walked my traders through it. As I said, options don't have to be so scary. We knew exactly how much we were going to risk if the market fell out of bed. And Lulu disappointed on earnings. That's all we were going to risk was 1 part, and then the 5 part reward is what came forward. But going forward on Lulu, I think as I scale out here just a little bit, I do think we have a longer term third wave going here in Lulu. 100% projection would be minimum in wave 3. Net percent distance traveled in 1 compared to 3 to put you at 202 in Lulu. So earnings are done. Implied volatilities come out of the earnings, but I think we're going to go back to work and put something on that's a little bit more of a longer term trade on the upside in Lululemon.
Well, 20 years experience certainly shows. It's very impressive. Thank you so much, Todd.
Thanks as always, Dana. Look forward to working with you again.